Hi. So in the previous presentation, we have discussed about variable cost and fixed cost, then direct cost and indirect cost, then how we will calculate variable and fixed cost when we know the total cost and different level of quantity. So this is what we have seen in the last video. So this video we are going to discuss about different types of cost again. So the first cost what we are going to discuss is product cost. So you can see here product or inventoriable cost. So what does this mean? This is what we have to going to see in this presentation. So product costs are cost of producing the product. Simple. So what cost you incurred to make a product, that is what actually product cost is. And these are the costs treated as product costs are inventoried and carried on the balance sheet. So this is a very important point. So product cost, it will be showing in the balance sheet first in the form of inventory, and once it is sold, it will go to the income statement. So we have a flow of journal entries that we can look here. You can see in this slide. Imagine you are working in a company where you are manufacturing goods and you purchased raw material. So when you purchase raw material, your journal entry is going to be like this. Raw material you will debit, credit, cash or accounts payable. So you have this raw material in your organization and that will be showing in your balance sheet, right? So you are debiting raw material, which is an inventory. So that is in the balance sheet now. So you have a raw material store and the goods are coming to the raw material store. Now you are going to issue material to production. That is what here, issued material to the production. So when you issue material to the production from the raw material store, you have to credit raw materials, because in raw material store you don't have these goods now, and it has gone to where? It has gone to the work in progress. Sorry, there's a spelling mistake in work in progress. Anyway, so it is work in progress. So now the production is happening. All the cost of raw material is now in work in progress. Okay. Now when this work in progress or production is completed, now all the work all the products completed you have to transfer to your finished goods. So you will debit finished goods, and now there is no more work in progress. So you will credit work in progress. And now all the cost is carried in the work in progress, in the finished goods. Now when these goods are sold, you will credit finished goods, because now that is not in your finished goods store, it is gone out, so you will credit, and this cost will go to income statement. So you can see all this throughout this structure of flow. You can see the first raw material you purchase, that is there in the balance sheet. Then you transferred those raw material to work in progress, still that is there in the balance sheet. Now you completed the work and all the cost is now in finished goods. That's also in the balance sheet in the form of inventory. So you have three types of inventory here: raw materials, work in progress and finished goods. Once it is sold, then only this cost of finished goods is going to income statement in the form of cost of goods sold. So you are crediting finished goods and now it reach your income statement. So until it is sold, this cost is not gone to income statement. So that is what it is mentioned here. The cost treated as product costs are inventoried first. It is in the balance sheet first and carried on the balance sheet until it is sold. So once it is sold, then only the cost of the production is going to income statement. Okay, hope you understand that. Now what are the things you will consider in product cost? You will consider direct material. These are the components of product or raw material, we can say. And also direct labor. We discussed about direct material and direct labor in the previous slide. So these two will be considered as the cost of production. And also manufacturing overhead. Okay, manufacturing overhead. This is like whatever the cost you incurred in the factory to make this product other than raw material and other than direct labor, or we can say the cost that is not directly related to the production, that we will be considered as overheads. We can say we paid rent for factory is an overhead because you cannot directly attribute the rent to any product. Or indirect labor, we can say you have a supervisor and his salary, he's not just working on one product, or he's not directly related to the production, he's supervising the labors, so his cost will be considered as an overhead. Indirect material also, maybe you need we can say diesel or something for your something fuel or something for your manufacturing equipments, or nails or glues. These are all not directly related to the production, because in our example we have seen you are an laptop assembly unit, and whatever directly related to the cost of the laptop, that is what actually direct cost is. So these are all indirect costs, or we can call it as overheads. Then maybe you can say rent, other overhead cost, electricity, utilities, depreciation, insurance, a lot of things are there. All this cost incurred but not directly related to the production, but these costs are needed to make the products. So that cost also actually we have to add to the cost of the product, because all this cost incurred to make the product. How we will do that we will see later in overhead allocation. So these are the three categories of cost that you are going to include in the product you actually produced. Or we can say all this cost will go to balance sheet first, then it will go to income statement when actually the products are sold only. Till that time, all this cost will carry in the balance sheet. Again, we will discuss this in detail in the coming slide. So we have three types of cost that will be carried in the inventoriable cost, or we can say product cost, which are material, direct labor, and indirect cost, or we can say overheads, which is manufacturing overheads. We have a lot of other overheads. Maybe you paid salary for HR people, maybe you paid salary for accountants. All these are not directly related to the product, so this cost won't be carried in the inventory. This cost, whenever you paid, and you will directly debit to your income statement, right? You will, when you pay a salary for an accountant, you will debit salary, you will credit cash. So when you debit salary, this cost is directly going to the income statement in the same period when it is incurred. But in case of product cost, maybe the cost incurred today, but that cost will not go to income statement until it is sold. Maybe the sales are happening next year, so the cost will go to income statement next year only. Till that time, it is shown as inventory in the balance sheet. But those non-manufacturing costs that you paid, it will go to income statement in the right period, in the same period. Because of that, these costs are called as period cost. So we discussed two things now: product cost and period cost. Product cost means that cost, it will be carried in the product and it will be shown in the balance sheet until it is sold. But period cost, it will be directly going to income statement when such expenses incurred. So we have two things: period cost and product cost. So being said that, now we will discuss again different classification of cost. So you can see here, the whatever cost we discussed, it will be classified as different types of cost, or it will be explained in different terminologies based on different situations. But the costs are same, but in different situations we will call this cost in different ways. So that is what we are going to discuss here now. The first thing is the main type of product cost in the previous slide can be further combined to create different cost classification. So whatever cost we discussed in the previous slide, so we will combine those costs in different ways and we will call them as differently. Okay, so we can say we have something called prime cost. What is prime cost? The same thing what we have seen, direct material and direct labor, when you combine together, that we call it as a prime cost. Material and direct labor. Then manufacturing cost. What is manufacturing cost? This include prime cost and manufacturing cost applied. Or we can say this will include direct cost and indirect cost of manufacturing. So it will include direct material, direct labor, and overhead applied. Overhead application, again we are going to discuss in the coming slide. Okay, so we can say three things are the material, direct labor, and manufacturing overheads. So this is what prime cost is, and manufacturing cost include all the three. Then we have something called conversion cost. What is conversion cost? This is the cost incurred to convert the material into a finished good. So here what we are not considering is the cost of raw material. For example, you are working in a company, or you are a company where you do manufacturing, but the materials are brought by the customers. Okay, so they will bring the material and you will be working on that. So you will calculate how much cost needed to convert this raw material to work in progress. So in such cases, we will use something called conversion cost. Not only in such cases, even the normal manufacturing environment, we will study later, process costing and all, will be using conversion cost. So conversion cost means how much cost incurred to convert the raw material to finished goods. So we will not consider here the material cost. We will consider only the labor cost and how much manufacturing overhead incurred. So here we are skipping the material cost. So conversion cost is labor cost and the manufacturing cost, manufacturing overhead incurred. So how much cost you incurred to convert the raw material into finished goods. This is what we call it as conversion cost. So that is explained here. You can see here, you can see material cost, then you have labor cost, then you have applied overheads. Again, application we will discuss later. So you can see here material cost A is 4 and labor hours 2. Okay, and it is overhead cost is applied on labor hours, that we will discuss later. So in short, we can say the material cost is 10, labor cost is 15, and overhead is 5 to make 1 unit of product. So these two costs, we said material and labor, we call as prime cost. These two costs, labor cost and applied overheads, we call this as conversion cost. And the total cost, the whole cost, we will consider, we will call as manufacturing, or sorry, yeah, the whole cost we will consider as manufacturing cost. One second. Yeah, the whole cost, all these three costs, we will consider as manufacturing cost. So you have three costs now: prime cost and conversion cost and manufacturing cost. Okay, so prime cost is material and labor, conversion cost is labor and applied overhead, all the three, it is manufacturing cost. Very simple. Okay, so we will go to next slide. So this slide actually discussing as a summary of what we discussed till now. What is direct labor? You can just read it. Direct material, manufacturing overhead, indirect labor, indirect material, all this we discussed already. And also we discussed what is prime cost, what is conversion cost, and what is total manufacturing cost. Okay, so all these three we discussed also. Now we have a small note here. When overtime must be worked, it is overtime. the overtime premium that is paid to worker is considered to be a factory overhead. So you are paying some overtime in your normal course of business. That overtime paid to employees will be considered as an overhead. It is not considered as a prime cost, or it is not considered as labor cost. Why? Because you worked over time, maybe because of your inefficiency. You were not able to complete the work in the proper time, so your laborers worked extra, so that will be considered as overhead. So that we can account those costs related to your inefficiencies in some way. But you have an order that need to be fulfilled today, but you cannot finish that during the office hours or working hours of the organization, because you got a special order. You have your current orders running, and in that case you ask the employees to stay back and finish the work. And in that case, the cost of the labor is not considered as overhead, but it is direct cost, because it is directly attributable to that particular special order. So if it is in the normal course of business, it will be considered as an overhead, but in this special circumstances, it will be considered as the cost of labor only. And this is talking about period cost. This already we discussed. Period costs are costs that are not involved in the production of a product. So as I mentioned, the salary paid to HR manager, salary paid to accountant, and all the expenses that you incurred which is not related to manufacturing, that will be considered as period cost. And period cost, as we said, these are expensed as they are incurred. Expense as they are incurred. You will be directly debiting that expense and crediting cash or accounts payable. So it is directly going to income statement. You can see the example: general and administrative expenses, legal fees. You paid a legal fee, so directly you will debit legal fee and credit cash or accounts payable. So it is directly going into income statement. These are we call period cost. We can take example: marketing expenses, accounting department. All these costs are going to income statement in the same period. And it is also possible that a company may choose to allocate period cost to production department, sometimes for internal purpose. Maybe company want to know, I want to cover all my cost by selling my product, not only the manufacturing cost, because I am incurring other costs, right? I have marketing cost, I have selling cost, I have administrative cost like accounting, HR, legal, IT, all the costs are there. So internally, for management purpose, they want to know how much total cost incurred to make this product, to make and sell this product. So sometimes what we will do, we will allocate all the cost, even if it is not related to the production, we will add to the cost of the product to understand the total cost incurred to produce and sell this product. Then we will see, okay, this is the total cost we are incurring and how much percentage of margin we have to add. So we will end up this total cost and we will add a percentage. But this is not accepted as per the standards. It is only for internal purpose. You cannot show this cost as manufacturing cost or product cost in your books as per IFRS or US GAAP. As per the standards, you cannot do that. But for internal purpose, for internal analysis purpose, you can do that. But again, this we will be discussing in another slide called service cost allocation. There we will discuss this in detail. Okay, so there is a way you can allocate this period cost to the manufacturing cost for internal purposes only, that we will discuss in the coming slides. Now here we are again discussing different types of cost that you may encounter when you are in a decision making position to comment on. For example, opportunity cost. What is opportunity cost? This is the cost of This is the cost of opportunity that you lost. The cost of opportunity that you lost. For example, you are starting a company and you are investing, say, $1 million in this company. And till this time, this $1 million was in your bank account. You have a term deposit and you were getting interest. For example, 3% interest yearly you were getting. So when you remove that money and you invest that money into this business, that 3% you will not get now. Correct? The 3% on 1 million that you are not going to get. So that amount of money that you lost, you will consider as an opportunity cost. This is the cost of the lost opportunity. But again, this cost we cannot include in the accounting books. There is no way, because actual cash outlay is not there. It is only for your decision making, for you to analyze, okay, I am getting 3% of 1 million, so I am going to invest that money in this business, so minimum I should get 3% from this business, otherwise there is no point. And anything above 3% is only actually adding me profit. So you can make a decision whether to start this business or not, but that is only for your decision making purpose. You cannot show this in your books, because actually spend, or actually you are going to spend, or any amount you spend and you are allocating, these are the three costs that you can show in your books. There should be actual cash outlay in the future or in the past or in the present. Then only you can include that cost in your books. But opportunity cost, it is only for your decision making. You cannot show that in your books. Then we have another cost which is called as carrying cost. Carrying cost is the cost that we incur to carry the inventory in our business. So when you have a lot of inventory in your hand, you need a store for that. So you have to pay rent, you have to pay electricity for that place, you have to pay salaries for people involved in handling this inventory. Maybe you have to pay insurance cost, and also you may have opportunity cost, because I put this money in inventory and my money is held up in this inventory, so I lost an opportunity to invest in somewhere else and I could have earned money there, but I lost it. So opportunity cost, that also can be considered as carrying cost. So in short, carrying cost means this is the cost to carry the inventory, to hold the inventory in your business. The more the inventory you have, this cost is going to increase. Then we have something called sunk cost. Sunk cost, these are the costs that's already been incurred and you cannot recover this. Again, this is also needed for you to make decisions in your business. So I will give you an example. Imagine you have a product, say it is some toys, for example, and you made this product for $60. Okay, you made this product for say $6. Okay, this is the cost of the product, but this product is no more sellable, it is obsolete. Okay, so what you have to do, you have two options. One is rework on this, spend $2, okay, then sell it for $3. You will rework and you spend $2, then sell it for $3, or you just sell it as it is, as a scrap to some some people who is buying scrap, and you will get $1.50. So you have to make a decision what to do now. Either rework and sell it or scrap it. Obviously you will scrap it, right? Because if you rework and sell it, you will get only $1 profit. Here you will get $1.50 profit. So your decision now is to sell this to scrap companies as scrap. Now what is sunk cost? Sunk cost is, in this case, is the $6. Are we considering this $6 to make a decision in this case? No, we didn't consider, right? Because that cost is already incurred that we cannot recover. So don't put that into our decision making process. So that cost actually incurred and it is not going to be recovered. This is what we call it as sunk cost. Then we have committed cost. These are the costs that for the company's infrastructure. So if you want to make your business ready for doing your actual operation, you need building, you need equipment, plants, furniture. So all this cost, in another term or another way, we can call it as committed cost. These costs are committed to do my business. Okay, so this is committed cost, mostly investment in your fixed asset or franchisee to run this business. What are all the things you need? Maybe you need license, of accreditation, whatever it is. So all the cost you incurred to run this business, you need that to run your business. So all these costs are committed to do this business, that we call it as committed cost. Then we have next cost, discretionary cost. As the name indicates, this cost you will incur based on the discretion of the management. So what does that mean? Management will decide whether to incur this cost or not, whether to advertise this year or not, whether to do maintenance for this equipment this year or not. It is up to the discretion of the management. Then that we call it as discretionary cost. This cost is incurred based on the decision made by the management. The next cost what we have is marginal cost. This again in detail we will be studying in part 2. Marginal cost are the cost necessary to produce one more unit. So you produced 100 unit, okay, and you are going to produce one more unit. So how much profit you are going to get from there? And to produce that last unit, how much cost you incur? So you will decide whether to produce the last unit based on what, how much cost I am incurring in the last unit and how much profit I am getting from the last unit. So marginal cost and marginal revenue, excess amount by selling that extra unit, how much revenue you are getting. I am getting $10 revenue, and how much you are spending on that last unit, I am spending $8. So your marginal revenue is greater than marginal cost, so you will produce. So this is what actually marginal cost. Again, we will be studying in detail that in part 2. This is a very important cost that we will make a lot of decision, especially short-term decisions. Then what we have is imputed cost. An imputed cost is a cost that does not exist but is needed for use in decision making process. This is same as opportunity cost what we have discussed. This cost is not actually there, but when we are making a decision we will consider this cost. The interest what we discussed, interest foregone or cost of capital, all these are imputed cost. So cost of capital is how much cost you are paying for the capital you raised. So when you want to make a decision whether to buy a plant and equipment or not, so what you will see, okay, if I want to buy this equipment, I have to take a loan, or I have to raise capital. For that capital, how much I have to pay? Because you cannot raise capital simply. Whoever providing you the capital, you have to pay for them, right? So that's the cost of capital. Again, whether to buy it or not, you will make a decision based on the revenue what you are getting is greater than the cost of capital, then only you will buy it, right? So that's what cost of capital. Again, in details, we will be studying all these things in part 2. Then we have engineered cost. So what is engineered cost? These are same cost what we discussed earlier, but here the term is different. They are called engineered cost. Why? Because engineers specify precisely how many inputs are required to generate a specific output. For example, direct material. When an engineer design a product, he said to complete the production of 1 unit of this type of product, you need 2 hours of labor, and you need 10 pieces of X unit and 5 pieces of Y unit as raw material, and the total cost of this going to be this much. So this is engineer specified. Based on the specifications you get from engineers who design the product, you got some cost. That cost we call it as engineered cost. Then we have common cost. These are the expenses a firm incurs as a whole, and which cannot be assigned directly to any particular department, product, or segment of this product. Or we can say cost incurred for the benefit of more than one cost object. So you can say you have a corporate office and you have 5 branches, okay, and your IT department is sitting and controlling all the IT operation from the head office, and you have expenses for them. You are paying salary and all other expenses for the IT department. So what you will do, this IT department is not incurred for corporate office, right? They are actually incurred for the company as a whole. So you will take this cost. For example, if it is $5,000, you will allocate this $5,000 to all the 5 branches, $1,000 for each, based on different allocation base that we are not discussing, but we will allocate this $5,000 to different 5 branches. So this type of cost we call as common cost. It is incurred at normally corporate level, and it is shared between different segments of the business. These segments can be branch, or it can be products or product line, whatever it is. So it is distributed to multiple segments. Then what we have is explicit cost and implicit cost. So explicit costs are also called out-of-pocket cost, and explicit cost involve payment of cash. So when there is a cash outlay, cash is going to out, then that cost we call it as explicit cost, anything related to cash outlay. But when there is no cash actually going to incur, that we call it as implicit cost. Or we can say the opportunity cost that we discussed, the imputed cost that we discussed. In these cases we are not actually paying, but we are only considering those costs when we want to make a decision. And also this implicit cost is called as economic cost, okay, or this is the cost of economist. So you can say we started a company and $100 I invested and I got $3, okay, profit. So for an accountant, there is no doubt we got $3 profit because 100 invested, $3 profit. But an economist will come and say, if you invest this $100, you could have earned $5 from a bank. So investing that here, you got only $3. So this company is actually $2 loss. Why? Because he's considering also the implicit cost or opportunity cost. So that is why it is called as economic cost. Again, we will be discussing this in later, economic profit and economic cost and all. So this is all short description of all the types of cost. So I think at this point we will stop here, and you will have a lot of theory questions to practice on this. So in cost classification questions, you will get a lot of questions and you have to go and practice all these questions in the application. Thanks a lot for watching.